how is your mutual fund performance? This is about helping you guys understand how to analyze the performance of your mutual fund, okay? How to better understand the fee structure and how to make informed decisions about which mutual funds to select based on that information. So the major determinant of mutual fund performance, obviously, are the fees associated with the mutual fund. You have front end, back end, and management expense ratio. Fees that are part of the management expense ratio include the management fee, the 12B1 fee, and other. Front end fees are fees that you're charged when you get into a mutual fund. Back end fees are fees that you're charged when you get out of a mutual fund. And the MER, or the management expense ratio, is a catch-all term that captures the management fee. The 12B1 fee is a marketing fee. Mutual funds basically charge you a fee to help it market itself or help them market themselves. Okay, so the 12B1 fee is a marketing or a distribution fee that mutual funds charge to fund holders to help them market themselves. Okay, so front end fees, back end fees. Turnover ratio essentially is a number expressed in percentage terms that helps you as an investor understand how frequently that mutual fund is buying and selling stock, buying and selling out of this portfolio. You want to look for mutual funds that have a low turnover ratio. Mutual funds that have a high turnover ratio typically underperform mutual funds with lower turnover ratios. Okay, quite simply put, the more frequently a mutual fund is buying and selling, the more wrong they typically are about market direction. Okay, so you don't want mutual funds that are basically trying to time the market. Okay, you want to get into a mutual fund that is a more buy and hold, long-term trajectory looking fund. Those are funds that typically perform really well over a long period of time. You want to look for numbers and do the analysis on numbers that help you determine the risk adjusted returns. Again, it's not about how much money you make, it's about how much risk you're taking to make that money. The Sortino ratio is a really good number that captures that risk adjusted return number for you. A 10% rate of return with a 5-point standard deviation is not the same as a 10% return with a 7-point standard deviation. Okay, again, risk adjusted returns over a long period of time give you an idea of how well the managers are managing risk within the portfolios. Okay, holding period and investment horizon are another thing you want to look at. How long you hold a mutual fund, how long you hold an investment, okay, will affect what type of returns you get. The longer you tend to hold on to an investment, okay, the better your overall performance will be. And that goes right back to the turnover ratio, which is exactly why you want to try to steer clear of mutual funds that have really high turnover ratios, because the holding period returns and the investment horizon are so limited. The investment horizon, excuse me, is so limited that their holding period return is not as high as it could be, because the fund manager or fund managers are constantly trying to chase after trends that are here today and gone tomorrow, instead of investing for longer term, bigger moves that happen. Okay, so skewed averages is another thing you want to look at. There are a million different ways to get a 10% average. Okay, you can get a 10% average by taking positive 50 and negative 30. You can get a 10% average by taking positive 40 and negative 20. You can get a 10% average by taking plus 10 and plus 10. Pay attention to the numbers that are included in those averages, because not all averages are the same. Okay, and which average you're talking about makes a difference. Okay, when you are determining an average for an investment, you take the product. Okay, you do not take the sum of the percentages, you take the product of the percentages. Okay, that is how you determine the true average rate of return for a particular investment. Recency bias. Past performance is not indicative of future results. You probably see that disclaimer at the bottom of every mutual fund prospectus or any other type of investment. Just because a mutual fund has performed well over the last 10 years or 15 years or 20 years, that does not mean that it will always perform well. The past does not predict the future. If the past predicted the future, every last one of us investment professionals will be gazillionaires, but it's not that simple. So whenever you're looking at a prospectus for any type of investment opportunity, be it mutual fund, a private investment fund, whatever it is, do not allow the recency bias to make you make a decision about the future performance that's not necessarily true because the past does not predict the future. So again, pay attention to the fees, look at the turnover ratio, risk adjusted returns, holding period, and investment horizon. Averages, make sure you know what's in those averages, and don't fall prey to the recency bias.